Matt Decker here with Leveraged Wealth Management. Today, I am doing a review that has been requested over and over again, and it is on the Allianz Life Pro product. Now, this product has been around for a good bit. It's come in several different variations. There's been the Life Pro Plus, the Life Pro Plus Elite. So don't get too confused on which product I'm talking about. Most of what I'm going to talk about today is going to be comparable or applicable to both products. Now, I'm recording this in 2019, so obviously things change, products change, and I have to be careful with this particular review. And the reason I have to be careful is because I really like this product. It's one of my top 3 products that I often recommend. And so the reason I say I have to be careful is because if you've watched any of the other product reviews that I've done, if you've seen my channel for any length of time, you know that I'm a huge proponent of designing these index universal life insurance contracts the right way. And by designing it the right way, what I mean is taking out as much commission as the IRS will allow while still retaining all of the tax benefits that we know and love with life insurance. So staying just within the MEC limits. Now, there are ways that you can say that you're max funding a contract without actually max funding a contract. So my caveat is this is going to be a favorable review. However, this product can be used the wrong way. And I say over and over again in just about every video review that I do, it's more important how the product is designed. It's less important which product you're choosing. Now, there are even caveats to that statement, because if you're choosing a product like the Pacific Life product or the Transamerica product or the Lincoln product with 3 to 4 times the average fees, that can be a disqualifier right out of the gate. But let's take those products off the table and let's just talk about the actual index universal life insurance products that are out there that have average fees, that are trying to do things the right way. If you take a look at the top 10 IULs that are out there, it is way more important that the policy was designed the right way versus making sure that you have the absolute best product. And I say all that because I think this is one of the best products. And yet, if it's done the wrong way, there can be some major drawbacks. And so that's what we're going to look at in a second. But first, I want to tell you why I really like this product, and really all products that function like this Allianz Life Pro product. I always start when talking about index universal life insurance with fees. And so one of the reasons that I really like this Allianz product is because the fees are in check with the industry average. That's the first thing. The cost of insurance, the per face fee, the premium loads and charges, all of that are comparable fees to everybody else out there that's A-rated, doing things the right way. Over and above that, though, there are no asset-based fees. So no asset-based fees. Now, the reason that this is important is because the 3 carriers that I just mentioned kind of in passing, Transamerica, Lincoln, Pac Life, they do have some asset-based fees, and that's what makes them so expensive. So for me, this one, no asset-based fees, I love that. I always try to use products that don't have any asset-based fees. I think that that's a mistake for an indexed universal life insurance product. So that's the first thing. The fees are definitely in check with the industry average, no asset-based fees. I really like that about this product. The second thing that I really like about this product is that it comes with a bonus. Now, the bonus in index universal life insurance contracts can be really convoluted. And the reason it can be convoluted is because there are different types of bonuses, okay? You have non-guaranteed bonuses and you have guaranteed bonuses. And even in the realm of non-guaranteed or guaranteed, you have multipliers and you have flat rate bonuses. So we'll just say multipliers and flat rate. Multipliers and flat rate. Now, this particular product, the reason that I like it is because it uses both a multiplier and that multiplier is guaranteed. And to me, that is crucially important because these illustrations that people are looking at, they are assumptions, right? Everything in them is assumed. the rate of return is not guaranteed. And so if you take an illustration that is already based on assumptions, and then you layer on top of that illustration a non-guaranteed bonus, now you're taking two kind of steps of faith, or you're placing your trust in two different elements inside the product. Number one, you're trusting that it's going to perform. Number two, you're trusting that this non-guaranteed bonus is actually going to be there, and it's going to be materially the same. It's not going to change over time. And a lot of times these non-guaranteed bonuses, they look really rich on paper, but the company reserves the right to change the bonus, how it's structured, how it works. And so I really don't like that. So when it comes to this Allianz Life Pro product, and really almost all the products that I recommend, it's going to have a guaranteed bonus, if any bonus. It doesn't have to have one, but if it has one, it's guaranteed. And really, it doesn't matter if it's a multiplier or a flat rate. The reason that I like this Allianz Life Pro product is because it is a guaranteed bonus, and it's a guaranteed 15% multiplier on top of your index credit every single year starting in year one. That's a really rich bonus. It's guaranteed, it's priced in, you know how to calculate it, and to me, that is extremely important. The third thing that I really like about this particular product are going to be the loan provisions. And so if you've seen any of my videos, again, I talk about loan provisions all the time. And the reason that this is important is because the loan provisions on the product, that's going to be how you access your money. So it's crucially important that you understand how you access your money if you plan on using this for supplemental tax-free retirement income later on down the road. Now, this Allianz Life Pro product, it happens to use, again, a guaranteed 5% participating loan rate. So no matter when you take a loan, you know that it's going to be 5% if you want to keep the interest earning power of your money. It's a participating loan, meaning you have $1 million in cash, you take a $500,000 loan, they're going to charge you 5% on the $500,000, but they're going to let you earn interest on the whole $1 million. So if the index does 10% that year, they charge you 5 on a $500,000, they credit you 10 on $1 million. That's extremely powerful. That's one of the reasons that these policies are so popular and the reason that they work so well. But what's important to know is that this 5% participating rate does not have to be guaranteed. Many companies will use a variable rate, okay, a variable loan rate, and it's tied to the Moody's corporate bond yield, which has a historical between, somewhere 6 to 7%. So they can show you an illustration that's using maybe a 4% current rate, but that rate can change. It's variable, and the historical is something like 6 to 7%. So you can imagine if they're showing you 4 and 15 years down the road, the rate is 6 or 7, that's going to be a problem because you're not going to get near the income out of that policy that it was projected to generate. And that's just a function of the loan rate changing. So the reason I like this product, the reason I like many of the products is because they either use a fixed participating loan rate, or it's a variable rate with a cap, meaning we know what the worst is going to be. The Allianz product just uses a fixed 5% loan rate. It also gives you the choice of using a wash loan, just like about every good company does, meaning they credit you to and they charge you to, and it washes itself out. So they give you that option as well. But in terms of loan provisions, probably the best thing about the Allianz product in terms of loan provisions is not the 5% guaranteed fixed participating rate. It's that they give you the ability to blend between the participating loan and the fixed or wash loan. So you can have 50% of your money using a participating loan. You can have 50% of your money using a fixed wash loan. It's just a way for you to customize things even further, take more risk, take less risk. It's totally up to you. It's customizable. There's really nobody else that allows you to do that blend between the different types of loans. You can move in and out of loans every single year as many times as you want. A lot of companies have a cap on how many times you can move between those loans. They don't let you choose a mix of the loans, and a lot of times they will make you pay the loan off before you switch from something like a participating loan to a fixed loan. So in terms of loan provisions, Allianz is king in terms of flexibility, and there's really no arguing that. The last thing that I really do like about this product is that it has really good crediting options. And not only are they good, but they are diverse. So there are a lot of companies out there that will only have, say, an S&P index crediting option, and if they have another, it's really bad. It's a low cap, it's a high fee, low participation rate. Allianz does a really good job of having an S&P index, but then also having some volatility controlled indexes. They have some international exposure. There's a lot of flexibility within the individual crediting options that you can choose from in the Allianz product line. And I think that that is crucially important moving forward. You don't want a product that's strictly tied to the S&P because it just gives you less in the way of diversification. It gives you less flexibility. When it comes to Index Universal Life, the things that are most important to me are the fees, are the bonuses guaranteed or are they not guaranteed, and then what type of flexibility is the company offering you in terms of the other provisions that are out there. How much control are they giving you versus how much control are they keeping? And the reason that I think that this is one of my top 3 products is because of these 4 bullet points right here, and it's just the most flexible product that's out there. Having said all of that, again, it's not so important which product you're choosing. If you're choosing something in the top 5 or the top 10, you can have a good product. That's not what's most important. What's most important is making sure that the policy that you have is designed correctly. If you have an IUL and you're not sure if it's designed correctly, you can go to my website right here, leveragewm.com/IUL-review. In a second, I'm going to show you this Allianz Life Pro product designed the right way versus the wrong way. And I'm going to show you why it's important to make sure it's done the right way, even though this is still a great product. But if you have an Index Universal Life, if you've never completed an IUL review, if you're not sure that it was designed the right way, go to my website right there, leveragewm.com/IUL-review. You can apply for a policy review. It's really simple. We'll go through it, make sure it's done the right way. There's a 4-question quiz on there. Again, very simple. But let me show you exactly what I'm talking about. So this is our Allianz Life Pro Plus Elite product. And you'll notice that this is let's actually start over here. So this is how I see most policies run. This would be known as a max funded Index Universal Life Insurance contract done the wrong way. Okay, so that seems counterintuitive. It's a max funded contract done the right way, or done the wrong way. I'm sorry. It's a max funded contract done the wrong way. So this is a 50-year-old male, preferred non-tobacco. And we're looking at $50,000 per year for the first 15 years. And then we're going to take basically just a lifetime stream of income off of this product. Now, the reason that this is done the wrong way, yet it's still max funded, is because you'll notice here the death benefit is basically level for all these years. So this is just a program solve in the software that says, give me the lowest death benefit possible if it doesn't increase. So if we just use a level death benefit, give me the lowest death benefit possible. Well, it just happens to be $2.2 million. Now, what's important about this design is the death benefit drives the commission, okay? The death benefit drives the commission for the agent. We'll table that and talk about it later. So we're paying $50,000 a year for 15 years, pretty simple stuff. And you'll notice it's kicking off an income of $94,678 every single year for life, which is a really big number. On the face of it, you're paying $50,000 a year for 15 years. You're taking out $94,000 for life. If you do that all the way out to, let's just say, age 90, you put in $750, you took out $2.3, and you still have $671,000 left over in the form of a death benefit to go to your beneficiaries. That's a whole heck of a lot of money. You're putting in $750, you're basically taking out $3 million. And all of that's coming out of the plan is tax-free, and you've done that along the way without taking any market risk. On the face of it, this is going to be an extremely difficult policy to beat unless you're just willing to go out into the market and shoot for, a 10 to 11% rate of return every single year in the market, even when you're, in your 80s and 90s, which of course nobody does that, especially if you're using that market-linked portfolio for income. If you're using a market-linked portfolio for income, there's no way that you're taking 10 to 11% in terms of risk. You're shooting for more like 4 to 6%. You adjust your risk because you're taking income out of your market linked portfolio. This is extremely standard. And so on the face of it, there's just no real way that you can compete with this unless you're willing to take a whole bunch more risk, okay? But I already told you, this was done wrong because we asked for the minimum death benefit based on a level solve. Minimum death benefit based on a level solve. That $2.2 million drives the commission, and commission drives the fees. So $2.2 million drives commission drives the fees drive performance, and performance determines your income. It's pretty linear, it's pretty self-explanatory. Let's look at how this should have been done. It's the same 50-year-old male, still preferred non-tobacco. It's the exact same product, Allianz Life Pro Plus Elite. It's the same premium for the same amount of years, and we're taking an income in the exact same year. We're using the exact same assumptions, but what we did, instead of a level death benefit, we used what's called an increasing death benefit, or an option B. Now, there's a way to do option B wrong, and there's a way to do it right. This is doing it right. And you'll notice we took our $2.2 million death benefit all the way down to $934,000. Death benefit drives commission drives fees drive performance drives income. Okay, that's the line of progression. So we've more than cut in half our death benefit, which should tell you that we've more than cut in half the commission and the fees, and our performance has gone up. And look at that, our $94,000, it was $94K, now it's $117,000 every single year for life, tax-free, no market risk. You take that to the same age 90, you put in $750, you took out $2.9, you still have $832,000 left over in the form of a death benefit. So we're talking about $3.7 million versus $3 million. So it's basically the same product. The difference is death benefit, which drives commission, which drives fees and performance and income. And so what did the agent do in this case? Well, what the agent said was, I would rather make 2.5 times more in commission dollars. And since I'd rather make 2.5 times more in commission dollars, I'm going to sell this policy over here with the higher death benefit. And what does that do to the client? It costs you $700,000 by the time you're 90 years old in additional benefits. So in order for the agent to make 2.5 times more in commission, he's costing the client $700,000 in basically lifetime benefits. And I think that this is borderline criminal, and that's why I make these videos. And the reason that I'm showing you this with a carrier that I really, really like is because it's not so much the carrier. If you're choosing a carrier in the top 5, the most important thing is to make sure that this policy was designed the right way. You can see the right way generates $3.7 million. The wrong way generates about $3 million at the exact same time. Right way versus the wrong way, but it's the same product, and it's basically funded. It is funded exactly the same for the exact same amount of years. The only difference is death benefit. Okay, and so what is the point here? Well, there's all kinds of ways that agents, bad agents, can justify higher death benefits. There's all kinds of ways. Hey, you need more death benefit, right? You need more death benefit. Why? Because you have young kids, you have a family, you make a lot of money, you need more death benefit. This death benefit drives things like long-term care coverage. It drives things like critical care coverage. So there's all kinds of ancillary riders that can be used to justify higher death benefits. And what I tell people all the time is, look, if you need more death benefit, but the primary purpose of this policy of paying $50,000 a year, if you're paying $50,000 a year into this to generate a maximum income stream, then you don't want a bunch of death benefit. If you think you need more death benefit, fine. Pay your $50,000 into this IUL policy, get the truly lowest death benefit possible, $934,000. And if you need an extra $1.1 million to get up to 2.2, buy a 20-year term policy, and you will be way better off because this term policy is going to be cheap. And guess what? You're not going to need an extra $1.1 million when you're 90 years old, but you are going to want that extra $23,000 in income. To me, this is a no-brainer. There's all kinds of ways bad agents can justify higher death benefits. I don't think it's right. I think that it's all rooted in them wanting to what? Make 2.5 times more the commission at your expense, lower distributions than they should be. So What do you need to do? If you have an index universal life insurance policy and you're not sure if it's this $2.2 million policy or this $934,000 policy, what you need to do is you need to go to my website, leveragedwm.com/IUL-review, leveragedwm.com/IUL-review. It's really simple to go through that little quiz. It's 4 or 5 questions. You fill out your information. It immediately sends you an email. It tells you what I need from you in order to complete your review. You respond to that email. We'll schedule that review. It's no hassle, no pressure. It's just a way for you to make sure you have something that's going to work for you long term and that's going to accomplish your goals. This has been Matt Decker with Leverage Wealth Management. Thanks so much for joining me. If you haven't already, subscribe to this channel, click the notification bell so you can be notified when I upload new videos. And as always, in the comments below, let me know what you want me to tackle next. Until next time.